Ladies and gentlemen of the crypto space, we're live on a Friday, September 9th at 12:10 p.m. A little late, but let's get out of stream. It's been a little light this week with regards to the amount of content that I could get you guys, but it's a nice topic to wrap up the week. It's a topic that I cover frequently. It's an idea that I present often, but I think it's probably the most resonant idea of everything that's going on because it's probably the grandest in scope. It's certainly not specific about an asset in particular. It's just trying to understand what crypto is relative to the rest of the world, putting it into a framework that compares crypto to everything that we've had historically. And it makes sense, it's logical, and clearly it's rational. Otherwise, I wouldn't be thinking about it. But I wanted to put context into perspective of something that is 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 digestible in traditional financial terms. And everything that I do is trying to understand crypto from that perspective, and it has proven effective thus far. So. Without further ado, let's pop it over to the main screen and see what's going on. So I got DeFi Llama up, and this has evolved significantly over the last year and a half or however long since they've launched, and it has a very nice presentation of aggregate information about what's going on in crypto. And this chart, TVL of DeFi, is significantly is probably the most robust of all the presentations about the overall state and is very applicable to the point that I'm trying to make for this stream today. TVL of DeFi, TVL of crypto financial markets, of such everything is so hyperbolic, that everything that traditional finance talks about with regard to crypto is so exaggerated about what it is. But really, what it is a market of products that are dealing with financial activity that are so comparable to exactly what everyone deals with in traditional finance: options, derivatives, leverage, market making, but forex markets and banking. So these are things that exist in traditional finance but are inaccessible in traditional finance. That's a common theme I've talked about quite often. Aave is a bank. Uniswap and Curve are market makers. And how were you a market maker in traditional finance? You were standing on the floor of the New York Stock Exchange with the little tickets and the blue coats. Those are market makers. But now you don't have to do that. Now you can do it digitally and with tools that, yeah, maybe they were available, but we don't know. Is anyone in the stream a professional market maker at some point back in the 80s and 90s, or however it evolved digitally in the 2000s and maybe even the 2010s? But this is certainly something that has no historical precedence, has historical overtones, and that's exactly the point we try and make. These systems are so comparable to the things that exist in traditional finance, yet they were either unavailable or not in existence to the degree that they are in DeFi, and that's why it's so cool. So $59.77 billion worth of liquidity is currently in the crypto market. And how does that compare to sovereign nations? Oh, I love saying that. You talk about pick a country, pick any country around the world, and what do they have? They have their own currency. They have their own financial markets. They have their own mining and commodities extraction from the ground and businesses to process and deliver them and manufacturing, so on and so forth. And they have people, and that's another story. That's something that's only for actual countries. So, but what do you have in crypto? You have financial markets. You have your own currencies, and well, I mean that's it. So you don't have people. But from a financial perspective, clearly you have currencies, clearly you have financial products and services. So you have businesses, you have enterprise. That's something exactly comparable to what countries do. So what do countries do with their currencies? What do they do with their commodity creation, their manufacturing and their people. Ultimately, it's something that folks don't like to accept, but you could look at the entire planet as a chase, a race to accumulate dollars. At least that's the status quo. And what you have historically is these cycles, emerging market cycles, and they go along for 5, 10-year, 15, 20-year cycles. And the great macroeconomists would be able to describe the emerging cycles much better than I. But what do I see? I see the same phenomena from a crypto perspective. You have an emerging market. China was much more of an emerging market in years past. It's still anything not the U.S., I guess you could consider an emerging market relatively. And then you have leading contenders for who's the strongest, and Ray Dalio talks about the changing of the world order. That's wonderful, but those are massive cycles. But all I really am interested in highlighting to the best of my abilities is emerging market or capital flow cycles, which is a chase to accumulate the primary currency used on the planet for the vast majority of transactions by a wide margin, which is dollars. So over years, countries have more and less dollars. So look, this is an emerging market. Look at what you have on this chart right here. What is this chart? Clearly there's a rational exuberance, and the chart indicates an excess of dollars was introduced to the crypto markets and has since exited as liquidity has dried up, the increase of the Fed rates, and risk has withdrawn liquidity from the crypto markets. But what is something I've always talked about? The ability for a market to capture dollars. And look, what does this chart so perfectly depict? Look where we are. We're at $59 billion. Where were we in 2021? $15.98 billion. And obviously, if you go back earlier, it was zero. 648 million. And in 2020, that's really where it started to get fun. Really, was there a half a $439 million? Was there that much? All right, maybe this chart. Maybe there was. Was there that much money? I mean, maybe it was like synthetics, and they're talking about market caps. So this is not necessarily exactly the chart that I'm looking for. I'm looking for not necessarily token value, but it's like in 2020, November, December 2019, Uniswap was dealing with $1 million worth of LP deposits. And how much stable coins were there, and what was the transaction volume through those market making positions. So while this chart isn't 100% what I would like to see, it is grossly representative of the phenomena that I'm talking about. The capacity for the crypto market, the crypto emerging market, to capture dollars. And clearly, in a year-over-year basis, if you here, I'll show you what I'm talking about. This is something I do often. If you snip this out, you snip it out, the irrational exuberance, make play that that's a black box. We are higher highs, $59 billion as compared to 2021, 40. 30, 20. I mean, it's trending upward, and this is depictive of the crypto market capturing dollars over time. And that is what excites me the most. Because if it's capturing dollars, it's creating reflexivity. Now, over the next 3, 4, 5, 6, 7, 8, 9, 10 years, we expect it to capture more dollars based on base formation. If we just had tightening of the U.S. financial markets with regard to liquidity, capital outflow from the crypto space, and this is the base foundation, what's the next irrational, exuberant quantity of liquidity? What's the next base quantity of liquidity? So this is really the first cycle. So folks would would say. I mean, I guess it very much is the first cycle. If you really look towards the DXY to see the cycles. So if we zoom out a little bit, you can see what I'm talking about here. So this is dollar liquidity. As the dollar is cheaper, liquidity flows into other currencies. As the dollar is more expensive, there's less liquidity in other currencies, and the strength is heading towards the dollar. There's more buy pressure on the dollar. So when you have the dollar going through depreciative cycle, value is flowing into other currencies. So that's exactly what I'm trying to express. We have yet to see. Bear with me a second. I'm getting a phone call. Let me just block that. Okay. So as we have yet to see well, we did see a relatively strong depreciative cycle for the dollar, and that was in 2020. So these purple boxes very nicely represent the most strength in a bull market move for the entire crypto space. And clearly, since June of 21, we've had dollar just ripping upwards, and we have all these macroeconomic conditions that we talk about to the best of our abilities. But what happens when this tops? And that's why I look at the dollar, because all we're dealing with, trying to understand what assets in the crypto space are going to appreciate, we need to see the dollar top. We need to see the value flow out of the dollar into other currencies. And what are we dealing with in crypto is other currencies. And what are we dealing with? The DeFi markets. We're dealing with a market of currencies. And we want to see liquidity flow in. We want to see this number go up. We want to see more liquidity. We want to see more transaction volume. We want to see more speculation, more accumulation, so on and so forth. And for that to occur, this number will be going up. And for this number to go up, we need to see excess liquidity in the system. And for that to occur, we need to see the dollar strength top. So that means it's cheaper to buy dollars, and other countries can print or do whatever the hell they're doing with regard to monetary policy, but they have an adequate supply of dollars, so they're paying less for dollars. If they're paying less for dollars, they have more of their currency. If they have more of their currency, they can engage in more financial activity. So when the dollar is strong, it just puts a depression across all other currencies and activity within their respective financial markets. So this is a very nice topping pattern. If it's going to top, it's going to top here. We're at resistance level with a clear, very clear rising wedge. And if it goes higher, Brent Johnson is talking 120, 30, 40, 50. That's going to be just devastating for international fiat money systems. How's the euro going to survive 120s, 130s, and 40s and 50s? It's just not. That's going to be a catastrophe. Like, this chart literally depicts the potential for humanitarian catastrophe. It's wild. But this is a heck of a shooting star. It's early in the month. There's still 21 days left in the monthly candle. But what you want to see is this. You want to see a close below resistance. You want to see a failed breakout with a large shooting star. And you want to see reversals to the downside. Basically what you saw in December of 2016. Tweezer top. I mean, this was a very large shooting star in March of 20. And then the depreciative leg. So, depending on macro conditions, you might see like support at a 103. Oh goodness, if you saw a support at 103 between these two green lines, that's not a pretty direction for the dollar with regard to global systemic financial stability. But there'll be one heck of a bull run in the crypto markets if you saw a strong depreciation of the DXY towards 103 from 108. See a 5-point drop, that's going to be pretty strong. And then from there, you can always speculate. You see a breakout of this ascending, rising wedge to the upside. That's not the pretty direction, but it is a rising wedge. A rising wedge is bearish, as per technical standards. Heck of a chart. So, patience. And that's my general sentiment. Am I positioning? There's nothing to do. Why do anything? You have your positions and you wait for liquidity to flow in. Sure, you can be the aggressive market actor and you can chase. You can chase gains, and there's few people that I know that are successful at chasing gains, and I give them all the props in the world. They're so impressive, and frankly, the folks that I know are great people. They're just good people, and I appreciate some folks I talk to more and more, just not because of who they are and the topics they talk about and just how successful they are. It's just in addition to all that, I get a great sense of their personalities lately. Um, and you could chase all you want. And just as long as you follow your rules. Now, me personally, I don't want to chase. I don't, and that I have excised it from my rules of engagement for the crypto space, and I'm quite comfortably refining my rules to be extremely passive. Because to me, what is my holy grail? My holy grail is owning assets that work for me, so I don't have to work, and it plays into a lot of the narratives I talked about, the pizza shop story and Warren Buffett, and not really Soros. It's more so Buffett and Charlie and how they manage their business operations by cash flow on the cheap. And Soros talks about reflexivity, so that would play into like the base of liquidity forming in the crypto space, and that's going to be a psychological factor. The next time liquidity is more easily available as the dollar starts to top, that would psychologically encourage more participation, more capital to flow in in the framework of an emerging market capital flow. So me, I love transaction fees. Anyway, I wasn't planning on talking about that. I wanted to, on portfolio management, especially my portfolio. Everyone at this point really knows how I engage with the markets and how I've structured things. Pizza shop passive, baby. I'm waiting for the liquidity train, and some folks would say it's not coming. Some folks would say it's inevitable. Currencies don't end in deflationary collapse. Currencies end by defaulting through inflation. I mean, that's just like 99.9% out of history. It's just all default through inflation. So it's very hard to get a sense of the market on short time horizons. And short time horizons literally is years. A year is a short time horizon. That'll blow your mind with regard to how far you have to step back and how much patience you have. It's not even, it's 3 years, 5 years. Imagine looking at charts on a 5-year time horizon. I mean, look at this chart. This is a chart of the dollar going back to 68. So we don't have that kind of contextual information in the crypto space. And you got all these young persons, and obviously yourself on the stream included, looking at hourly, daily, hopefully weekly, preferably monthly. And I say that's even too short. What you want to do is set up for the yearly chart. You want to think in terms of yearly capital flow cycles. And the great macro folks will talk about 5-10-year capital flow cycles. Where's the capital going to flow and why over a 5-10-year time period? If you set up your capital with that kind of time horizon and the capital flows there over 5 years, woo! That changes everything. But it also means you're sitting on positions for years for your hypothesis to play out. I love watching this chart because this candle is such an extraordinary candle for the rest of the year. September, it's the end of the year. This is the candle that defines the end of the year, and the end of the year will provide confluence and confirmation for the setup for 2023. In so many regards, looking at this chart combined with, let's say, the 10-year right down the pipe, the middle of the yield curve, this sets up the tone for literally what Fed monetary policy does, what central bank monetary policy around the world does, what the world does, And it really tells us what the rest of the world is doing with regard to their sovereign reserves. I mean, this chart literally tells us that countries around the world are selling their bonds. And this is an interesting trend shift. We've been seeing yields go up and the dollar go up, which is very much representative of countries selling their bonds to buy dollars, and obviously they're buying dollars to service debts. Who's going to buy a dollar at this price point unless you needed to? And the only reason you need to is why? You guys have played around with Aave and health factors. They're buying the dollar at these high exchange rates because they need to prevent liquidation. They need to pay their monthly bill on their debt obligation. That's the only reason you have to buy dollars. Or maybe you need to buy energy. You got to buy oil priced in dollars. But of late, you're starting to see oil available in many countries not priced in dollars. So there's your 5-10 year macro time horizon. Some shit is starting to change because you can now buy oil in the open market, not in dollars. I mean, literally, we went to war in the 90s with Iraq because they dared to price oil not in dollars. That's a very interesting argument I've heard of late, and it makes complete sense. But look at the trend shift. Yields are up. There's 4 hours left in the weekly candle on the 10-year yields, and it would be the first time if it closes above this green line that it closes above October, November 2018 yields. The white line above will be a significant structural change as compared to historic bond price action. And we observe bond price vis-a-vis the inverse, which is yields. That'd be a significant structural change. How things play out, we don't know, but all we know is today. Too many folks, you look into the future too much, and it'll drive you mad. You got to play the market as it is today and prepare for the future. But so many folks are so diehard about like yields collapsing for so many different reasons, and if yields keep rising, what does that say for the entire financial system of the world? Because the entire financial system is really dependent on countries placing U.S. sovereign debt in reserve, and then the U.S. Executes deficit spending at the fiscal level, and then the U.S. is buying goods and services from overseas, which is historically how we export dollars, and other countries finance their dollar-denominated business activity. So if the U.S. And there's a variety of different ways that the system's capital flow is changing and can continue to change over the coming years, but you're only going to see that over year time horizons, 3, 4, 5, 6, 7, 8, 9, 10 years. You're not going to see that on dailies and weeklies. All of that stuff takes a long time to play out, the significant capital flow changes. But this chart, along with the DXY, are grossly representative of significant changes that are occurring in the system or may potentially occur. So they're very broad. They paint a broad picture of things that are going on. Clearly, you can look at dollar charts, dollar forex pairs, and you can see what's going on in individual countries. But this is a decent basket of currencies, broadly representative of the euro and Japanese yen. But the euro and yen are paired with they're relatively significant currencies. So what goes on in Europe and what goes on in Japan affects the other currencies. Those are the smaller actors. They're more marginal on the global scale, which obviously sounds horrible from a humanitarian perspective, but that's another story. Let's hit some questions and help you guys out. I think that's a good story for today. Liquidity, patience, long time horizon. So what do I want? I want transaction fees when this thing says $1 trillion in DeFi. And when you have $1 trillion in DeFi, what's that $1 trillion doing? It's chasing yield. It's chasing capital gains. And to do that, you're executing transactions all over the place. And what do I have to do when there's $1 trillion in DeFi doing all the work trying to outperform, trying to chase yield. What do I have to do? Nothing. At the base layer. And that's what I want to do, because then I could focus on other things. But owning a piece of the base layer is how you do that. But that has a long time horizon. And that requires commitment, conviction, and all the shit that everyone talks about. But that's something I think I can do. It's nice that VE tokenomics allows you to do that by force. So that's really the question. Do you opt into that? Because that is a big thing. It makes VE tokenomics truly a purchase rather than a position. How do you commit to something like that for so long? You know, I say that rhetorically, obviously, because I know. I know how I commit to that because I have. And that's my degree of conviction. Raul's in the house. Tapsy, back to back. Nice noise, Tapsy says. Zoidberg's in the house. Matthew, thoughts on Lightning Network? Run a node. Manager can earn 3-4%, not outpacing inflation. I'm not a fan of Lightning Network. I'm not a fan of Bitcoin in general. It has significance with regard to a capacity to avoid confiscation resistance. It's meaningful from a macro perspective. It catches the fancy of the ultra wealthy. Saylor's narrative is spot on with regard to Bitcoin, but it's only applicable, his narrative, in my opinion, to two scenarios. Other countries that are hyperinflationary and clearly even Bitcoin depreciating like 40, 50, 60, 70%, it's going to outperform something that's hyperinflating 800% or 1,000%. So that's quite meaningful for them, not for us with the dollars, but for another currency. So that means folks do have to consider in other currencies a dollar purchase via stablecoin, which is going to be significantly less volatile as compared to Bitcoin's volatility. So there's a great deal of complexity even from a humanitarian perspective for countries that are experiencing hyperinflation. Bitcoin relative to a stablecoin. That's interesting complexity. But there is considerations, like dollar stabilized Bitcoin using perpetual swaps, delta neutral positions. That is interesting. It just doesn't garner my attention to an extreme. And then there's obviously the other narrative of Saylor, which is how do you preserve money for 100 years. So clearly, in 100 years, all these fiats are dead. Everything is dead. It's all gone. It's a completely different system. The world will be a completely different place. There will be no such thing as the current dollar. And then who knows? Wild thoughts about what happens in 100 years. But what will exist in 100 years, and that is what Saylor thinks about, and I think that makes perfect sense. But that's not applicable to me because I'm not interested in preserving value for 100 years. I don't have $50 billion available to me. I don't have an empire like that. I'm not thinking about a dynasty and a trust of that nature. So that is outside the scope of how I interact with markets. And I'm obviously in between that scale and smaller scale, which is looking at, probably a 10x return on $100 to make $1,000. Certainly not a day trader in any regard. So that's the story that I present to you with regard to the spectrum of the ways that people interact with these markets. I doubt any billionaires are listening to me. But they're the ultra passive, and that's the Bitcoin crowd. Sovereign nations, people that have hundreds of millions of dollars worth of gold and what are they going to do with their money for 100 years? And they're thinking of that kind of time frame. So we're not thinking of that kind of time frame. I'm not thinking about the daily and the weekly. I'm thinking more of really the yearly time frame at this point. And that's why I like this chart so much. It helps me build conviction and confidence in my narrative that dollars have been captured. Does this chart not show that dollars have been captured in crypto finance, the crypto emerging market? $60 billion compared to June, 438. Now clearly there was less than $1 million on Uniswap in November of 2019. So this is not exactly the point I'm trying to make, but the fact is, pictorially, it depicts the point I'm trying to make. Heirloom, appreciate your analysis. I appreciate your appreciation of the analysis. Mike, does the exit include stables? I'm not quite sure what that means. Exit. Uh, well, this is the capital that remains circulating across the protocols below. So DeFi Llama is hot. It tells you a significant amount of information about the state of the liquidity in the crypto space. Bear asset plus yield generating, mind blown. Yeah, the fact that we've had yield this entire time is extraordinary. And that's the story I've been trying to express as best I can over the last, at least a year. It's a very different way this stream started. We did a lot of different things. I know I don't understand why GMX is going that high because of the transaction volume and partially because of the narrative that I tell you guys. It's a productive asset. It's an enterprise. You could evaluate it from a P&E standpoint. You could evaluate it from a cash flow standpoint. Clearly, it's a cash flow positive business. They got cash coming up the wazoo on a daily basis, the amount of transaction fees that the protocol is generating for itself as well as for the people that have access to the daily cash flow vis-a-vis interest on ESGMX as well as GMX. It's clearly a good cash flow positive protocol, but most of the fees goes to GLP, not GMX. But those are the liquidity providers. You need to pay people to provide working capital. So GLP is working capital, whereas GMX get a fraction of the fees, and most of the yield is ESGMX. Well, this all makes sense. Most of the fees, you think of all the fees as capex, and the capex is being deployed to finance working capital, GLP, as well as finance the optimal state for governance, which is ESGMX, because ESGMX is locked. So those participants are most aligned with the success of the protocol, because the lock ESGMX is a 1-year vesting period. You have to be very committed to the protocol in order to do it. So they should be paid the most. You want to pay the committed persons versus the non-committed persons. So GMX has completely nailed how to do crypto or DeFi or a digital enterprise right. In hindsight, I didn't see it for what it was going to become, but man, they nailed everything. I think I had a chance at $10. They nailed everything. Just an anecdotal evaluation right now, GMX nails the business of what they're doing to the T, including their capex. GLP over GMX, over ESGMX, over GMX. That is the appropriate balance for optimal efficiency of their capex deployment. That's it. Hope that helps. If FedNow is coming out next year, wouldn't the Fed be able to target markets for liquidity inflows, making dollars spendable on food, shelter? This would stop assets from ballooning. Unknown. But FedNow is an extraordinary topic. There's a lot of people talking about that. And I briefly understand it, and I would need to digest it a little bit more. But obviously, if it's significantly faster, it facilitates better capital efficiency, better liquidity flow between the entire U.S. dollar market, which means capital can get to where it needs to be faster. So that'll facilitate better stability. It'll facilitate different types of enterprise, because if you got to wait a day for a variety of capital transfer mechanisms, or even a wire transfer, the amount of time it takes as compared to instant, that changes the type of business that you could operate. So that's very it's interesting to say the least, and it has positive as well as negative potentials. One Curious View, good morning. What's good? Another day, another day. It's Friday. Happy to catch a stream. It's Unicron here. Happy to learn heaps from you and the contrarian perspective. Anything we do against the status quo nowadays is pretty much the right way. Um, Most of what I do, I like to think is is protective. It's certainly sustainable. It's certainly not going to make the most. It's the safest presentation for people that listen to me because it's not like I'm saying, go buy Dogecoin, it's going to go up 1,000%. So it's the safest story to present, but it's the easiest story for me to present because it's the way I live my life and it's what I do for myself, which plays into how and why I'm able to do social media and these streams, and why I'm able to always have content to talk about, because I'm literally talking about how I engage with the markets, what I do, the way I think. So I have an endless supply of content for you guys. Got to wait for Q3 volatility. It'll come back. I look forward to volatility. When we get volatility on Curve, you got $1 million daily transaction fee volume, and that's very nice. When Curve's making, if Curve made $1 million a day, that'd be a lot. That'd be a $7 million week, and the largest week I think we've had is like 4 and change, and that's because they found a bunch of fees that were not distributed. But if Curve could pull out $1 million a day in transaction fee volume, and that's what VE Curve is paying, VE Curve would be paying like 70-80% of the money in transaction fees, and I think that's where the market's heading. Base VE Curve 70-80%. Oh. Do you remember that week when they distributed four and change $1 million? I think it was 70%. So $1 million a day in transaction fees, that's like 100%. Can you imagine base VE Curve paying 100% in stablecoins? Oh goodness. So to see when that is potentially the case to occur, you got to look at this chart, the liquidity. How much liquidity in the system you think is needed, and the stability for that potential volatility for those kinds of transaction fees to occur. The stability of the amount of liquidity available for that kind of capital flow within this particular market. They'll play all sorts of games to bottle liquidity before midterms. They need this win, then it'll crack. Yeah, that's a narrative that's going around. Maybe the Fed has overseas market making operations in equity indexes. You never know, and that would make sense. I mean, look what the S&P is doing. The fact that the S&P is above 4,000 is wild. But from a monthly chart perspective, I mean, this is a massive drawdown with regard to time. This is many months. This is all of 2022. I mean, this is approaching the last time we had a drawdown this long was 2008. The other ones were tiny in comparison, even especially 2020. Time frame wise, this is the largest bear market in time since 2008. And bear market, they'll say, is 20s, whatever, there's 20 something percent down, or whatever it was. It's trivial with regard to price point, bear market qualification. But it's downturn, and if you look at the TWAP, and I like to look at the chart like this, this is the largest downturn since 2020 because of the time frame. So this is a 1.5% drawdown on average monthly. That's the drawdown. And it's almost just a joke of a chart, because there was no drawdown at all in March of 2020. So this is a wonderful way to peer through the bullshit of all the media, the insanity, COVID, or whatever, there was no drawdown. This chart tells you month over month what the S&P equity index is doing from a futures market perspective, of course. But there's literally been zero month over month drawdown, or relatively zero. I mean, what's 1.55% since 2008? This is a wild chart to look at. Look, this is a chart. This is a peer through the madness chart, the ultimate peer through the madness chart. um, Selling bonds to raise cash to pay debts. Yeah, but we'll see that stop. Because if the dollar's not going up, that means something is changing with the capital flow. So if this tops out at the resistance of the rising wedge, something's changing, and that would be very interesting if bond yields keep going up. But it would be nice to see the dollar come down and bond yields start to come down, bond prices going up, buying pressure on bonds. That would mean there's some sort of stabilizing harmonic where you're seeing the right directionality for these assets to head towards a stabilizing direction rather than an increasingly scary direction. Because if bond yields keep going up and the dollar breaks out, bond yields will keep going up because they got to keep selling debt to buy more dollars at a higher price, and it's just it's the death spiral. So it'd be nice to see this start to come down. I'd like to see it pull back below the 41-year trend line, which is all the way down to 2.7% compared to 3.3% where we're at. It'd be an interesting complexity if bond yields break out and bonds keep selling and the dollar has a significant retrace to the downside. That'd be an interesting story to try and digest. European counter moves happening soon with respect to Russian energy situation. Well, we'll see. You can't print energy, but they're making liquidity tighter. So I was thinking something earlier, maybe liquidity is relative. So if the European Union, ECB, tightens, doesn't that make other currencies relatively looser? So maybe that's why we see the appreciation in the markets, because the dollar is looser. If the euro is tighter, something else that didn't tighten is relatively looser. I think that makes sense. I think so. Jesse, hey, good morning. Love the catching the live stream. Thank you for your insights. Stay rational. That's the name of the game, boys and girls. The most rational community in the entire crypto space. Matthew, I appreciate your perspective and pushback. Always happy to have it go back to the drawing board and improve deeper conviction. Thanks for what you do. By the way, Taro allows for stablecoins to be issued on Bitcoin. Okay, so with regard to the narrative that we talked about today, what kind of liquidity? What kind of capital flow? What kind of volatility? What kind of transaction volume? And that's how you measure a market. You measure an emerging market with the amount of dollars it has trapped. So over the coming years, we will see how many dollars in stablecoin form, using Taro on Bitcoin, as you suggest, it has a capacity to trap. Nope, I'm going back here. Okay, I should have muted that before I started. I don't handle streams perfectly to this day because we can do better. Remember that 4 million weekly? It was the first one for me entering the position, an odd start. Yeah, yep. That was wild back then. Kingmaker looks like Luna is paying the investors now, sir. What are your opinion? I'm not interested in a bankrupt company. No interest. Great. Hertz made it back to life. Everyone bought Hertz's bonds and shit, and AMC and all that stupid stuff that died during the pandemic. They died because they had too much debt. So I'm not interested in Luna at all coming back to life. James dropping in on a Friday, getting the Noah knowledge. James, pleasure. Yeah, well, we do things differently around these parts because this is a bear market and we see these nice rallies. But where's it heading? We don't have the liquidity. We don't. Until you start to see a red-ass candle on the DXY, we're not going to see the market do the magic. And that is exactly why this is the bull markets. This is it. This is where Bitcoin ripped from $300 to 20 grand, or $800 to 20 grand. And this is where Bitcoin ripped from $3,000 in the collapse in March of 2020 to 68 grand. Those are these purple boxes. So you're not going to have rallies. You're not going to have ridiculous crypto rallies up here until you start to see them red candles print on the monthly. You're not going to have ridiculous crypto rallies until you see the liquidity significantly go up, because that's your DeFi activity. Or you'll see, obviously the liquidity on centralized exchanges is another story, but this is your DeFi activity liquidity meter. We see the transaction volume going up is because liquidity is flooding into the space and capital is chasing yield and capital gains. That's the name of the game. All right, boys and girls, Friday, September 9th, 12:56 p.m. As always, thank you all for joining me. It's been an interesting week. I wish I had time to get more streams out, but we'll be back on track next week. I wish you all a good one. Tell everyone to subscribe, because I can only help someone if they actually listen. You know the deal. After party on Discord for the most rational community in the entire crypto space. I'll be in there all day. I wish you all a good one. Have a safe weekend, and I will see you on the flip side. Peace.